A good afternoon, everyone, and a warm welcome to you all joining us online for this final installment of the Erudite webinar series co-hosted by the Institute for Security Studies and the Africa Policy Bridge Tank at AUDA-NEPAD. It's been an enriching journey throughout this series where we've explored many dimensions of African futures, from the future of African employment and manufacturing, and now finally to this final topic, mobilizing Africa's financial flows for Africa's development. Now, this discussion couldn't be more timely. Across the continent, economies are contending with the twin challenges of disinvestment and diversification, whilst also seeking new paths to finance long-term growth. Now, this conversation today will focus on the complex dynamics of financial inflows and outflows, examining the roles of official development assistance, foreign direct investment, remittances, and illicit financial flows. To that end, we couldn't be more privileged than to be joined by two exceptional thought leaders whose work continues to influence policy and foresight across Africa and beyond. And these are Dr. Marvelous Ngudu, from the ISS African Futures and Innovation Program, and Dr. Lina Benabdallah from Wake Forest University, whose research bridges global political economy and Africa's role in the international system. Together, today we will reflect on Africa, how Africa can chart its financial destiny, not as a passive recipient of global capital flows, but as an active shaper of them. And now to give us a good overview of all that we have just mentioned, I am proud to introduce the marvelous Ngudu to please present his presentation for us. Dr. Ngundu, the floor is yours.
Thank you, Mahao. I'll share my screen and kindly ask you to confirm if you can see it. Can you see my screen?
We can, marvelous. Please proceed.
Thank you so much. So this presentation draws on our latest report on financial flows. If you go to our website, navigate to the thematic page, just click the down arrow. You'll find the report here, financial flows. So there is an option to download it in PDF for those who would like to read it offline. The theme analyzes how finances flow into Africa through aid, foreign direct investment, and remittances, and what this means for the continent's future. So the central question is how Africa can better harness these financial flows to close its substantial investment gap, and also to accelerate its development agenda. In general, we use international futures model to answer all the foresight questions within the African context. And for more details regarding the international futures model, you can navigate to our technical page. Just go to about this site. There is a section that is dedicated on how international futures model work and how we use it in forecasting the long-term future of Africa, its countries, and also its regional economic communities. The software is hosted and was developed at the University of Denver. And it uses historical data to identify the trends and generate the baseline trajectory, which we refer to as the current path scenario. So our impact assessment is based on how each modeled sectorial scenario compares favorably with the business as usual or the baseline or the current path scenario across the key development indicators. And our forecast horizon is currently up to 2043, which is the end of the third 10-year implementation plan of the Africa's Union Agenda 23. Meanwhile, we are focusing on 8 sectors, which is demographic and health, agriculture, education, manufacturing, large infrastructure and leapfrogging, the free trade, financial flows, and governance. We model a scenario for each sector, then we compare how it impacts the development indicators of Africa and disseminate the policies on how Africa can maximize its potential in each sector. Then we also model the synergistic effect, which are the interventions across all these sectors. So it's more of a combined impact of all these sectors on the development outcomes of Africa, and we call it a combined scenario. So the presentation today is a snapshot of the financial flows scenario. And what I'm going to do is just to give a snapshot of Africa's financing needs and the trajectory of the external flows up to 2043 under the current path. I'll also dwell on each financial flow, starting with remittances, aid, illicit financial flows, and FDI. Then I'll highlight how we conceptualized our financial flow scenario, then also present the findings and end up by giving recommendations based on what we find out. So Africa faces, that's according to the Africa Development Bank, Africa faces an annual financing gap of over 400 billion. That's up until 2030. This is well beyond the reach of the current domestic resources, with tax revenues averaging only about 16% of GDP. This is also far below the rate or the level that is experienced by the peer regions in the South Asia and also in South America. What this means is that external financial flows are critical to fill the financing gap that Africa is currently facing. And going to the graph that you see on your screens, we make a current path analysis of 3 major external financial flows into Africa, which is foreign aid, net remittances, and FDI. What we see is that the trajectory is positive, yes, with FDI increasing from approximately 67 billion in 2023. That's about 76 billion in 2023, I'm sorry, to about 230 billion in 2043. Then we also have the aid rising from approximately 65 billion to around 100 billion in 2043. And we have also remittances rising from approximately 70 billion to approximately from 70 billion to approximately 94 billion in 2043. So we often talk about these large investment, which is FDI and also aid, because those are well acknowledged external financial flows in Africa. But we tend to forget that the African diasporas are also contributing decisively towards the cake of the external financial flows in Africa. And this graph shows that net remittances are competing among the other external financial flows. But despite this growth, this positive trajectory under the current path, we still do not have to neglect domestic resource mobilization because they remain fundamental. And without stronger institutions and revenue systems, external inflows alone cannot meet Africa's investment and development needs. Right. Looking first at remittances, which in 2003, they hit around, in 2023, I'm sorry, they hit around 90 billion. I'm talking of remittance inflows, not net remittance, with about 20 billion as intra-African transfers, and as always, North and West Africa received the largest share. So these diaspora funds are lifeline for households, directly supporting education, food, health care, and sometimes filling in the foreign exchange gaps. So they are paramount to be included in all the policy discussions that involve external financing in Africa. However, remittances generally don't automatically translate into investment in business or industries. In fact, what theory tells us is that a heavy reliance on remittance can lead to what they refer to as the remittance trap. This is when an easy inflow of money from abroad leads to complacency. Governments might feel some sort of less pressured to create jobs for its citizens, citing reasons that they receive some foreign currency from their loved ones abroad. And another challenge that is associated with this form of external flow is the issue of high cost. Sending money to Africa costs around, on average, 7%, which is the highest in the world. So where possible, people try to run away from this high cost and resort to informal channels. So bringing those remittances that are channeled through informal channels to formal channels could, in fact, improve both security and give government better data to work in developing policies. Now turning into aid, which Africa receives so much compared to other developing regions. Africa significantly receives more aid per capita if compared to regions like South Asia, for instance, and South America. And this is due to widespread of poverty in Africa and also the issue of state fragility. So in 2003 alone, we see that Africa countries received about 65 billion in aid, which accounted bulk of the global aid in the low income countries globally. And aid support essential services like remittances. It does support essential services such as health and education, especially in low income countries, where it constitute around 35% of the government revenue. But we should take into cognizance that lay aid is affected by geopolitics, and you've witnessed that in the recently this year. We have seen the US disbanding USAID uh, and slashed development aid under the Trump administration. The UK as well and other global north countries have shifted their priorities from aid to domestic priorities. So such cuts, they threaten critical programs in vulnerable African states, especially in the health and humanitarian sectors. But aid remains crucial, but we should take careful cognizance not to depend so much on it. Now let's talk about the negative side, which is the illicit financial flows. And statistics shows that Africa loses almost 90 billion every year in illicit financial flows. And this is a massive figure. Think of a situation where for every dollar of foreign aid coming in, a comparable amount might be flowing out illicitly. It is like trying to fill a bucket that is leaking, and we need to work on plugging that leak, because it's costing Africa quite massive in terms of its development. Where is this money going? These illicit financial flows. The majority, about 65% of these illicit financial flows, stem from commercial activities such as trade misinvoicing and tax avoidance by multinational companies. Then the other 35% are from the criminal activities and corruption. So these outflows, they drain fiscal space, cutting health and education spending and increasing the debt dependency, and they need to be kept. The FDI, which is often seen as the most desirable kind of flow, because it doesn't bring only capital, but what we have experienced is that it also brings in technology. It also creates jobs, brain drain, which enhances skills development, and it also enables access to the global markets. Be that as it may, FDI in Africa remains modest, remains small. In 2022, Africa captured only 3.5% of the global FDI inflows, which is around 60 billion. And this is well below what South Asia and South America captured. South America in 2023 captured something over 600 billion of FDI, compared to 90 to 95 billion in Africa. So the main factor that determines the flow of aid into Africa has been the institutional quality. Africa has often been unfairly seen as a high risk region of conflict and instability. While this is true for few hotspots, of course, I must acknowledge that some African countries are now stable and they are reform oriented. So this perception gap um, means Africa's high potential, including some of the world's highest returns on FDI, are not fully utilized. So we need to bridge this image problem through success stories and continued reforms um, in Africa. Who is investing in Africa? So our traditional investors are Europe, and they remain Africa's largest investor up to date, though declining, and it's a worrisome situation to see the de-investment at the rate that you see on your screen. US is also de-investing. Its investment in Africa has been reducing, but at least we have China joining Europe and US, and it's been rapidly expanding its investment in Africa, surpassing the US around 2010. Other emerging economies that are investing in Africa also include the UAE, India, Turkey, Japan, and Brazil are also showing much interest, expanding their investment, especially in infrastructure, green energy, and also the consumer markets. But critically, we should also acknowledge that intra-Africa FDI is also rising, led by investors in South Africa investing in another countries in Africa, investors in Kenya and also in Nigeria, investing across the continent in the banking, in the telecom, and also in the cement sector. We have seen some progress. But the challenge now is to try and diversify beyond mining to manufacturing, green industrialization, while also addressing the persistent perception of the African premium, which is the risk associated with Africa. So the African governments is a task to rethink this status quo. Flows are declining at the time when they are needed most, and we need to work on this. Then our financial flows scenario explores an ambitious but realistic future where Africa sees higher external flows in form of aid, in form of FDI, remittances, and also having a robust capacity to clamp down on illicit outflows. As you see on your screen there, it models how such changes could boost development, focus mainly on economic growth by 2043. And the bottom line is that the more inflows help to boost the capital accumulation, knowledge and technology transfer, though they may not be the silver bullet without parallel domestic reforms, but they do contribute significantly to these factors: capital accumulation, technology, and knowledge spillovers in particular. What is it that we found out? So our results shows that if Africa could orchestrate this big push of financial flows by 2043, Africa's GDP could be about 240 billion, higher than the baseline scenario. So that's a sizable boost, roughly aiding an economy that is of more or less equal size of Algeria. So it's considerable. On the capita basis, average GDP per capita will be 160 higher than the baseline forecast. But more importantly, This growth means that 20 million more people will be lifted out of extreme poverty as measured on a person living on less than $2.15 US dollars per day. Then looking on the specific flows, you'll see that under the financial flows scenario, FDI inflows will rise to about 5.3% of Africa's GDP by 2043 versus 3.6% under the baseline scenario. Then the scenario also sees potential to harness remittances even more. By 2043, net remittances could reach around 121.5 billion compared to 94 billion in the baseline. That's about 27.5 billion higher. So this difference comes from policies that make it easier and cheaper to send money, and perhaps economic growth in host countries allowing migrants to send money. So given how directly remittances alleviate poverty, that additional 27.5 billion goes a long way on poverty alleviation and uplifting the standard of the people. Right. So what should we do to arrive to this journey in 2043? We need to strengthen our absorption capacity to meet, especially to meet the expectations of the investors. Our governance institutions are currently compromised. We need to reform. Our skills base is low. We need to upskill. Our infrastructure is not reliable and is poor below the level expected by investors. We need to upgrade our infrastructure. We also need to mobilize our domestic resources, tax reforms, and pension funds. Target strategic FDI, make use of the investment protocol that is defined under the Africa Continental Free Trade Area Initiative, and prioritize the sectors that have got high returns and can create industrialization and also create more employment for the Africans. We also need to leverage remittances through lowering cost and encouraging investment, maximize aid, and also combat illicit financial flows. So what I'm saying in conclusion is that external financial flows, be it remittances, aid, or FDI, offer critical opportunities for Africa. They can help fill the investment gap, they can create jobs, they can reduce poverty. But they cannot substitute the strong domestic policies. We still need to make sure that we reform our domestic mobilization, resource mobilization policies. And that responsibility lies on the African governance to make sure that they've created an enabling environment where all these funds are used wisely and strategically. And some of the things that they need to improve to make sure that this happen is by improving governance and pursuing deliberate reforms to ensure that every aid dollar that is received, every investor euro that is received, and every diaspora remittance that is received works in tandem with the domestic efforts to achieve the continent's development aspirations. Thank you so much, Mahao. Over to you.
Wow, well, thank you, Marvelous, for that magnificent presentation, really framing our discussion today as we head into our question and answer session. And just before I do that, if I may just inform all the participants online that there will be a Q&A session where you will be allowed to chime in and pitch questions to the discussants that we have. You may also post your questions in the chat function as we go along. Now, Marvelous, while I still have you, I mean, your report highlighted that we have this massive financing gap on the continent of about $402 billion. But at the same time, you highlighted that increased foreign direct investment, aid and remittances, and reducing those illicit financial flows could raise Africa's GDP by 244 US dollars, billion USD, above the business as usual scenario by 2043. What policy shifts are needed right now to achieve this future?
Thanks, Mahal, for that question. So it shouldn't be a single policy, but an integration of different policies. But for this presentation, I'll outline perhaps 3 or 4 issues that are needed urgently. And those are also the low-hanging fruit that African governments can prioritize on. So the first thing is to make investment policy explicitly developmental. And the African governments have been missing this. They were just going with the mantra that Africa is open for business. But what business is the question that needs to be answered. And one of the issues that need to be addressed under that is they should prioritize and expedite the implementation of the tools of the Africa Continental Free Trade Area Initiative Investment Protocol, which include investment facilitation, development-oriented incentives, the issue of tech transfer, and supply development provisions. So this should be done at a national level, but also align with the targets of the intellectual property automation to make sure that value chains that fast track industrialization in Africa are prioritized. For instance, agro-processing, taking advantage of the green minerals that we have, renewables, and also digital. Secondly, African governments should make sure that they lower the cost of remittances and formalize these flows through fintech. So the push must also enable to allow like competition within that sector, because competition brings efficiency from the economics point of view. Then fintech in the payment systems enforce full price transparency at the corridor level, and also meet the SDG 10C. The SDG 10C targets 3% cost target. But if you look at the sub-Saharan Africa, especially during the first quarter of 2025, it costed something like 9% for somebody to send an amount of equivalent of 200 US dollars to Africa. So that 9%, you can see that is triple what we are targeting under the SDG 10C. So we still have a problem there. Then, of course, the problem child is the illicit financial flows. What we can estimate for now is 89 billion annually. Just imagine what is not accounted for. It should be massive. And that 89 billion, to make matters worse, is comparatively and in most cases far above what we receive as foreign direct investment. So it's actually taking a negative step behind where we should be now. So we need to prioritize in curbing the illicit financial flows through public beneficial ownership registers, and implement also e-invoicing for custom systems, systematic price variance audits, especially for minerals, and automatic exchange of tax information. I was checking last week, how the United Nations Economic Commission for Africa estimated that of 90 billion that is lost through illicit financial flows, 40 billion is lost in extractive industry alone. So there is need to prioritize curbing of illicit financial flows, especially in this industry. Finally, we need to stabilize our public finance to make sure that they crowd in instead of crowding out private investment. And this can be done by strengthening the debt management. We need to reduce areas and avoid crowding out banks, especially with the heavy domestic borrowing, because this is now a systematic risk that is predominantly flagged in sub-Saharan Africa. Thank you.
Oh, thank you so much for that, Marvelous. Now, Lena, to bring you into the discussion. Marvelous, I think, has done a very good job at painting the Africa's evolving investment portfolio. What does it tell us about the continent's place in the shifting global economic order? You are sitting there in the United States. Can you guys also highlight to us why the traditional foreign direct investment FDI sources, such as the United States and Europe, are currently disinvesting actually or stagnating in Africa at a time when capital is most needed? I think Marvelous said that we only capture about 3.5% of FDI, and that is declining.
Yes, thank you, Mahal, for these questions. And I'm very happy and honored to share the panel and to share the stage with you, Mahal, and also with Marvelous. It was a wonderful presentation that we saw, and I full-heartedly agree with all the points that Mahal made and that Marvelous made about. So what we're seeing in terms of these patterns of foreign direct investment, in terms of how much of that is being captured, and obviously sort of without dismissing all these important angles that were mentioned by Marvelous, specifically looking at sort of this issue of illicit financing. The numbers there are very staggering, as well as sort of this cost of doing business in the continent, as he very eloquently kind of captured for us in terms of the high cost of investing, in terms of these kind of more or less intercontinental or domestic issues. We also have to look at sort of the international element as well, right? So we have to look at these kind of external pressures and external issues that are coming in and weighing in on these pictures on the pictures that we saw with Marvelous, really amazing presentation. But then sort of one can argue that sort of Africa has always been at the center of shifting global economic order, and it is now even more at the center of this shift in global economic order, with the continent's endowments in sort of natural resources, critical minerals, its sizable markets, its growing middle class, and young population. Africa is indeed at the center of these shifting economic order. As you mentioned, these traditional FDI sources, including from the US, from the EU, UK, are backing away, right? So we are seeing a decrease in these FDI, sources. And as mentioned by Marvelous, this is also, echoed, right, in terms of looking at even sort of, World Bank reports and other places also are echoing these sentiments and echoing these observations that FDI flows are slowing down. And sort of we are in a moment where we're seeing companies right now rethink their supply chain considerations. We are seeing these tariff barriers. We're seeing companies that are reshoring their companies and their businesses away from Africa, from other places, and bringing them closer, basically to the US or to Europe. So we're seeing less flows from these traditional actors, indeed. But this isn't the full picture. Obviously, we have seen from Marvelous's presentation that Africa doesn't get a whole lot of FDI anyway, right? So Africa's share of FDI, global FDI, is very slim. It's very small. That is in itself can be viewed as an issue. It can be viewed as a challenge. It's problematic that we're capturing in the continent that little small little piece of the big pie. But at the same time, one can argue because it's already always been very slim, right? These abrupt changes that we're seeing in global economic order are not necessarily impacting the bigger picture, right? So I think where Marvelous was talking about in terms of the remittances, there's just so much more going on there, right? Than in terms of sort of, especially in terms of foreign aid and these kind of cutbacks in foreign aid supplies. But the other side of the picture is, even though we are seeing sort of FDI flows from the US, the UK, Europe going down, we're seeing a rise basically of foreign direct investment and financial flows from emerging economies and from non-traditional actors, including many in Asia. Sort of Marvelous mentioned China, where we saw FDI from China to Africa rise from something like $75 million in 2003 to several billions in the span of 2 decades. So we're seeing these increases, right? So India, Turkey, several Gulf countries as well. We're seeing increasing FDI, coming into the country and then into the continent. So the question here for us in terms of long term is, as African countries and governments are rethinking these global economic shifts, are we just going to sit here and wait until there's another rotation, right? So there's a rise of FDI from global, from kind of Western capital, and then that goes down, and then we have a kind of a rotation where global capital from Asian countries and Gulf countries is going up, and then so what happens? Are we going to wait until there's another cycle? When that goes out down, some other countries. So the questions here are, how does the continent sort of try to get ahead of this in terms of finding a sustainable way to not necessarily depend or rely on these foreign investments, but also really figure out a way to capture what investments and FDI is available today to manage a more sustainable way of ensuring that we're not sitting here waiting for the next rotation of who is going to be at the helm of FDI and where the continent sort of partners are going to shift in sort of in a musical chair type of situation. So I think that's an important aspect of this.
No, thank you so much for that, Lena. Just continuing in that vein, in this landscape where we're seeing this decline in FDI, especially from our traditional partners, you mentioned, Marvelous, that remittances is an area where we're actually seeing significant growth. I think between now and 2043, roughly the remittances are actually going to double between $5 and $10 billion. And they are currently now the largest source of external finance for Africa. In your opinion, Marvelous, are we doing enough to leverage this flow for development, or are we missing an opportunity?
The straight answer To your question, Mahao, is no, we're not doing enough. We can do better. The first thing I indicated is the issue of the high transfer cost, and that is discouraging African diasporas to utilize formal channels. And so the first thing that we need to do is to make sure that we have slashed the transfer cost to the target of the SDG 10C, 3%, currently at 9% of $200 cent in the first quarter of 2021 is too much. That's exorbitant. So could it be that African diasporas have got an alternative of using informal channels? They would rather prioritize that. So let's take it quantitatively. 2024, we recorded between 95 96 billion of remittances. Those are the ones that we can be able to record. Just imagine the ones that are flowing through informal channels. They could be even more than the ones that are flowing through formal channels. So we are missing that opportunity. Then, so what is the solution for that? Fintech is the solution for that, and lowering cost, making sure that we allow competition within that sector for for the purpose of price to at least drop a little bit down, and also publish the corridor level league tables to spur that price competition within the sector. The second thing is, of course, now remittances are tailored through the livelihood needs, education, health, food. They are not being tailored through investable channels, savings, and etc. And it's up to government to scale diaspora bonds and regulated diaspora funds that are linked perhaps to infrastructure development, small to medium enterprise pipelines, of course, with forex and government protections. I wrote a blog specifically on how remittances should be channeled from the household to the investment instruments, and borrowed on that blog. I borrowed some of the cases, especially from the global south, and that blog is there on our website to those who would want to go through it. But I want to give an example, one of the notable example. In Nigeria in 2017, Mahau, if you can remember, diaspora bonds raised something like 300 million US dollars, and they were subscribed by 130% oversubscription. So that is a proof that a clear concept of an instrument, when it is well structured, can actually translate to something tangible in terms of development. The last thing is, of course, we need to tailor our remittances, mainstream remittances, to be linked into the financial inclusion. Meanwhile, remittances are not incorporated as instruments that can actually facilitate that financial inclusion. So in that regard, government needs to facilitate policies where remittance receipts are used to example underwrite credit histories. They are used to facilitate mortgagee bonds. They are also integrated with savings and some of the insurance at the last mile. The other thing that can be done is also the issue of the mobile money ecosystem. M-Pesa in Kenya is a very good example of that. And it has shown how policy enabled digital rails can actually multiply development impacts. Thank you, Mao.
Thank you so much, Marvelous. You've actually answered the last question that I wanted to ask you, that if you had to advise the AU or National Treasury on one policy to unlock external capital flows, what would it be? So I'm going to, in the interest of time, because I also want to bring in our online participants, shoot that question to Lena. But in this form, Lena, for you, how can African countries create a more compelling narrative to global investors about the continent's investment readiness? Marvelous very brilliantly highlighted that we have this perception gap as well, that Africa is seen as a high-risk continent. So how do we overcome that as African states?
Yes, I think that's a very important part, sort of this bias that we see in sort of in this credit rating agencies and this persistent perception of high risk and low return in the continent due to these kind of narratives that we see in the media, we see in popular culture, we see all around sort of about the continent being sort of associated with instability and security, all of these things that are contributing to sort of this perception of high risk, which again, as explained by Marvelous, and as we know, has very palpable and tangible implications for investments, right? And the continent, it is causing or costing the continent actually real money. And so it's important to kind of have agency over these narratives. It is important to have agency over how these perceptions essentially are creating different sort of investment conditions in the continent. So I think maybe one way for the continent to create a more compelling narrative, I think basically it's kind of what Marvelous was saying earlier, sort of these examples, it's just giving examples of how things work. Specifically in Nigeria is extremely interesting right now because, we just heard the example given by Marvelous, which is essentially nothing short of an amazing, successful example of how to capture remittances and, again, sort of remittances and turn them into investment. But at the same time, right now, we see the global narrative around Nigeria and the global narrative essentially spun by the US these days, and how Nigeria is kind of shaping up to be in part of conversations in US politics is actually all about sort of, hyped up kind of narratives. It's really not coming from the continent. It's coming from outside. A lot of it is. So it's very important to essentially have the capability of controlling some of these narratives. And so some of it has to be done through, I guess, lobbying, sort of direct lobbying, to have people placed in positions that can essentially stop some of these. A lot of it is fake news. Not all of it is fake news, but a lot of it is. We saw the same thing about South Africa in terms of, what the US is essentially spinning as narratives about South Africa and about it, the reasons why the US isn't even participating in the G20. So the sort of some level of lobbying and some level of being able to kind of exercise that voice over these narratives. And it's not, at this point, it's not even creating more compelling narratives because we know Africa is attracting investment. It's just not attracting Western investment these days, but this is on Western capital, right? This is not about the continent in sort of this way, because we have seen the numbers indicate we're seeing a rise of investment from Turkey, from India, from China, from Gulf countries, right? So it's not necessarily about sort of this attractiveness of the continent, but it is about these narratives that are coming from the West, right? Essentially thinking about Africa as a place of, we have to stop migration from that place. We have to solve problems sometimes that don't even exist in the continent, just so that they don't come to us. So I think that these for a better sort of exercise of agency over these narratives, we need to have people placed in positions that can actually in this way reverse some of these narratives and counter some of these narratives that are being actually spun right now about Nigeria and about South Africa, for instance, in the US, for example, right? So which are, again, tarnishing these places and kind of driving away every possibility of students thinking about going to study in these places, of tourists thinking about visiting, of investors, of sort of these are important at this time, not necessarily because the continent is not attractive, because we see it is attractive to some other capital, but to think about sort of what narratives are being spun at the moment, and trying to kind of have some lobbying power to kind of stop that or change that.
Thank you so much for that intervention, Lena. I will now open the floor to a Q&A session. Unfortunately, given our very limited time left, I will only take 2 questions. So please feel free to unmute your mic and then tell us who you're pitching your question to and proceed to do that. But before I do that, there is a question in the chat function from Teresa Smout. I will start with that. And she says, a great presentation, Marvelous. Thank you. Now, can the integration of AI tools be a game changer in strengthening capacity and improving governance and accountability? Marvelous.
Thanks. Yes. Thanks, Mahal. Thanks, Teresa. Yes. AI is a game changer, especially in the digital space. We have indicated quite a number of reforms that can actually help in curbing, especially illicit financial flows. If everything is automized, what is it is that there will be less of a human influence in trying to manipulate the system. Then AI on its own, if not incorporated in the key sectors on where it's needed most, we can actually make a slogan on it and we'll never achieve anything. We need to make sure that AI is implemented on fintech, to make sure that remittances flow through channels, formal channels. We need to make sure that our systems are automized so that there is less influence of the human manipulation that can curb illicit financial flows. We can even use to strengthen our government structures, which, by the way, governance is one of the attracting factor of the foreign direct investment. We can use AI to try and turn around this narrative of the African premium, which is the perception that Africa is a high risk place. Let's publish data and make it available through AIs. So there's quite a number of issues that can be attained through AI, yes.
Okay. Thank you so much, Marvelous. And now I will allow for just 2 questions. And if you can keep your question very brief and succinct. And if I can ask Marvelous and Lena, if you can kindly respond to the questions in 2 minutes and not more than that. So whomever would like to take the floor and ask your questions, now is the time. Please unmute your mic and proceed. In the absence of questions, I will take it that our presenters today have done a sterling job, as we knew that they would. And then say thank you so much to you, Dr. Benabdallah and Dr. Ngundu, for those rich and thought-provoking insights that you provided for us today. And thank you to all our participants for joining this final session, at least for this year, of our Erudite webinar series. Today's session underscored that mobilizing Africa's financial flows is not just about attracting capital. It's about governance, strategy, and narrative. We've heard that to unlock our full potential, Africa must reframe its global investment story. That's that perception gap that we spoke about. It must channel remittances and domestic savings more effectively and also stem illicit financial flows that erode public trust and resources. Now, as we conclude this year's series, one thing stands clear. Africa's development financing future will be defined as much by how we manage our resources as by how we mobilize them. Now, on behalf of AUDA-NEPAD and our partners at ISS, thank you once again to our distinguished panelists, our audience, and all the teams behind the Erudite series for their continued collaboration in advancing African foresight and evidence-based policy dialogue. With that, until next time, thank you, take care, and God bless. Thank you.
Thank you.